right, welcome. My name is Walt Powell. My title is Lead Field CISO, so I am a recovering CISO who now talks to other CISOs about kind of high-level strategic and risk topics and helps them be better CISOs when I can. I lead a team of guys just like myself, and as part of our mission, we're constantly trying to put together information and write white papers and whatnot. And I started writing a white paper about the cyber insurance space and inadvertently stumbled across a framework, basically a how to procure cyber insurance framework that evidently didn't exist before. So I wasn't set out to create a framework for how to procure cyber insurance. It just kind of happened. So what we're going to do tonight, sorry you drew the short straw that is wonky C-level cyber insurance talks at 8 o'clock at night on a Thursday. We'll see if we can keep you awake. I'm not going to guarantee anything because it's cyber insurance. I'll do what I can. So we'll take a look at the space that is cyber insurance. We'll talk about the problem a little bit, but if you're here, you probably know what the problem is. We'll dig a little bit into the things that you can do to address it, and we'll get into some of the nuts and bolts, and we'll dig kind of deep into some of the things that you will find inside of policies and some of the gotchas around some of the different things that are going on around exceptions and language and terms and stuff like that. So real exciting stuff. So yeah, we're going to take a look at that framework. We're going to take a look at how you can leverage insurance to buy down risk and use it for risk transfer reasons, and looking at it from a risk lens as a way to buy down your risk. We'll take a look at the application process, some of the policy language. We'll take a look at what you can do to kind of drive down some of your premiums a little bit, because that's one of the things that people really care about. And then ultimately what we're trying to do is get to the point where we can talk about making sure that you're getting what you pay for and that your claim's ready, so if the bad thing happens and your hair is on fire, that you are prepared to use this so that you are getting what you paid for, right? So there are a few things that are going on here historically, right? So the cyber insurance market has kind of been in a rough spot. And I have people come up to me all the time and they say, hey, in 2023, is it smart for me to even get cyber insurance? Is cyber insurance going to continue to be a thing? Is this market going to fall on its face? And I don't know, 60 days ago, I might have given you a different story than I'm going to tell you now. I'm hopeful, or more hopeful at least, about the cyber insurance market than I was 60 days ago. So there are kind of a few things that happened. So when they started offering cyber insurance, they started offering it for the kind of obvious stuff, right? Like, hey, this is breach insurance. They didn't really have enough risk information. They didn't have the actuarial table information to understand the risk. They were just cutting policies because they thought there was good money in it. Kind of at the same time, the cyber threat world got stupid. So in 2017, we had NotPetya, which looked like ransomware, but was not decryptable, and it got out and caused a lot of damage, like major, in the billions of dollar damage, to folks like Mondelez, the Oreo cookie people, and the shipping magnates and whatnot, who then filed claims not just on their cyber policies, but on their D&O policies and on their property policies and stuff, and it really created a problem for the insurers, and we'll dig into that more a little bit. And on top of that, following right behind that, we started to see the shift toward the kind of new multi-extortion ransomware that we see today, right? That we steal your data before we encrypt your data so we can ransom you on multiple fronts, and it's everywhere and it's all the time. And that they weren't prepared for either, and created a situation where there wasn't enough money in the market to sustain the outlays that they were paying, right? However, a few things have happened. So we've gotten to the point where they're starting to have enough data that they have enough risk information now that they're starting to be able to understand what their risk is, and they're starting to be able to write policies appropriately. And just recently in that national strategy that the old government put out, right, there was a bunch of stuff in here about they're going to put backstops in place, and they're intending, as part of the national strategy, to backstop cyber insurance. However, it's a little bit weird the way that they've done it, and we'll talk about that more when we talk about terrorism exclusions and stuff like that, because they haven't been very clear about how they're going to backstop it. But it feels to me more like there's a good chance that this is going to continue to be a market going forward, but maybe not for everybody and maybe not for everything. I think we've seen the high water mark of all the things that will be covered. So they've gone kind of crazy with we're going to cover absolutely every type of harm. I think you're going to see a reduction in that. They've also gone crazy with we're going to cover everybody who wants it, and I think you're going to see a little shrink there too. And some of that's going to happen naturally through attrition, and as we talk about the application and the things that they make you go through to get the policies and the crazy application you have to fill out, like some of that's going to fall off because you're not going to be able to meet the standard, and it's not going to become, it's not going to make financial sense for you to do this, and so you're going to fall off on your own. So I have a sneaking suspicion that going forward into the future, we're going to see that the policies kind of focus more on the big players who are building towers and maybe is not such an SMB play. However, there are some players who are focused in that space, so maybe we'll see that shore up a little bit. So they've been trying to figure out what are the things that we can do to reduce our risk. And a lot of the really meaner things that they were doing early on, like sublimits and all these things, have actually kind of fallen off a little bit. On the flip side, it's been difficult for folks to buy cyber insurance. So not only has it been difficult for the cyber insurers to provide cyber insurance, part of the problem with the market is it's been difficult for organizations to get cyber insurance. So only 19% of organizations have coverage over $600,000 today, and the average claim in 2021 was $900,000. So there's a $300,000 gap for almost every organization. And you would think that is probably because of cost trade-offs. It doesn't make financial sense to transfer out these risks, but that doesn't seem to be the case at all. Pretty much all of these studies, and this particular study came from Deloitte, says that the big drivers for why folks don't have cyber insurance are they don't understand the coverages, they don't understand the policies, they don't understand the application process, they don't understand why they need it, they don't understand their risks, are the big buckets of things that this fall into. And so one of the big reasons that we don't have better coverage is because folks struggle to understand how to align the coverages. So that's the problem, kind of in a nutshell, right? Like I said, early on, people said, hey, should I continue to get cyber insurance in 2023? And I said, my answer has changed. My answer is still yes. So it continues to be one of the best ways that you can buy down risk in 2023. If you take a look at your cyber problem as a pure dollars and cents risk problem and say you have a, I don't know, X $1 million exposure to risk and you want to buy it down a certain amount, right? Your policy is $2 million, $3 million, $5 million, whatever your policy is, right? You're buying down your risk by that $5 million for whatever your premium is. Premiums, I don't know, even at a crazy amount, it's $100,000. It's $200,000 would be a crazy premium for that type of coverage. What else could you go buy? Is there any other vendor in this hallway that you could go spend $200,000 on and reduce your risk by $5 million? And the answer is no. Like, there's not an amount of CrowdStrike or Palo Alto you can go buy at that price point that would reduce your risk that amount. So it continues to be a really good investment. And when I hear people say like, hey, the prices have gotten out of control, really the prices have gotten about right. They used to be wildly underpriced, and we got used to that. And now when people say, hey, my premiums have doubled and tripled, they have, but they're about right now, whereas they were crazy underpriced and we were getting insane deals before. 2 and 3 years ago, I was seeing people get $5 and $10 million policies for like $12,000 a year, and that's an insanely low amount of money for what we know the actual risk is now. People got spoiled on that a little bit. So yes, I continue to think that it's a smart thing to do. However, there is a breakover point where it does and doesn't make sense when you look at it from that risk point of view. So if you're looking at it from that risk point of view, you have to figure out, does this investment make sense for me? Does it make sense for me to take that premium money and stick it in that kind of risk reduction through cyber insurance? Or does it make better sense for me to take that same money and stick it in controls or stick it in something else to reduce my risk? And that calculus is different for everybody. So You would think that it might skew to the lower end for who that would make more sense for, but like recently JP Morgan Chase decided they're not paying for cyber insurance anymore, that they could better spend their money on their own controls. They no longer pay for cyber insurance, they spend that money on other stuff. However, they're JP Morgan Chase and they have giant in-house, every kind of thing you could ever imagine, their own in-house forensics and malware reverse investigations and you name it, right? So they can do a lot of things that other folks can't do. They can also do a lot of self-insurance. They can also do a lot of like capital restructuring and holding. They can build their own captives. They can do a bunch of stuff because they're a financial organization that a lot of people can't do. But you can make those same kind of calculus. And so as we look through like the framework that I said I inadvertently made a framework, the framework is 4 parts. So the first part is that discovery part, right? Understanding yourself, understanding what your risks are, understanding what your coverage needs are, understanding what your current coverages are, understanding what your current situation is from a controls point of view, right? And we'll talk about that a little bit more. The second part then is I need to fill out the application. I need to take that information from phase 1 and plug it into the application and tell it to the insurer in a way that tells the story that I want to tell to drive down my premiums and help my insurer understand what the risk is, because my insurer has a tendency to ask the wrong questions and I can help them by giving them the answer they actually want. But also, I need to be careful not to lie to them, because there's a trap right now where it's very, very easy for you to inadvertently lie to them and give them a reason to deny you later. Then stage 3 is they're going to give you a policy full of legalese that you don't understand, and it is very easy for you to sign on the dotted line to a policy that is full of terms and conditions and exclusions that undermine the reason that you thought you were buying insurance in the first place, that are the key things that you thought you were getting, and you potentially didn't realize were excluded or were not part of your terms or did not cover the thing you thought was covered. And then the last part is, how do you make sure that whatever is in the policy is the thing you're doing? So often when I talk to CISOs and whatnot, and we're talking about building their incident response plans or the formal incident response plans or whatever, and I say, have you looked at your cyber policy? What does your cyber policy say you need to do? Have we lined it up to your incident response plan? The answer is almost always, no, I've never even bothered to read the policy. Of course, we didn't line it up to the plan. Well, we got to be doing the thing that the policy says so that we get paid, right? So we'll talk through that a little bit too. So those are the 4 phases. So in phase 1, oftentimes people in phase 1 think like bit site and they start and end there, right? Like I'm going to go out and I'm going to look at some external score monitoring folks. And that's a great place to start. There's nothing wrong with looking at your BitSite score or your security scorecard or whatever it is you like. And some of the different insurers have started to build their own version of this. And getting an external view of you and your score is a very good and smart thing to do. The same way that you would go check your own credit score before you made a major house purchase or whatever, and you would clean up your credit before you went and applied for a mortgage, you should be doing the same thing here. You should be understanding what your external view looks like, and you should be cleaning that up in advance of going out and asking for the policy. However, that's not the only thing you should be doing, and taking that outside-in look is the thing we're always talking about is, hey, we should be taking an inside-out look first, right? We need to understand our risk and why we're doing this and what we're trying to accomplish, because A, the cyber insurer really wants to know what our risk is. We also want to know what our risk is so we know that we're doing the right thing and we're making the right choices. So this outside-in look is a great starting point, but it is not the end point, right? Also, it's very chucked full of, I don't know, false positives and junk. So it is very common that you'll go out to the BitSite site and it'll just be full of just like stupid crap you have to negotiate away, right? And you're just talking, you call BitSite and be like, this is dumb, make this go away, this is real. You can spin off whole parts of your business to make it look better. You can do all kinds of stuff. You'll find that BitSite says one thing and Security Scorecard says something different, and you got to get them to jive, and you spend a bunch of time trying to get all that worked out. Also in this phase, we should be looking at the main controls that they're going to ask for. And they're going to ask for a baseline of stuff. Unfortunately, they have not gotten together into a like real formal, like, hey, this is the formal bunch of stuff, because it's a very competitive industry, and like understanding risk and driving down risk is the competitive advantage. So there's not a formal framework for this yet, but there's stuff we know they're going to want you to have. They're going to want you to have MFA. They're going to want you to have EDR. They're going to want you, and this year's big thing has been privileged access management, and they just say that like it's no big deal. Like, why don't you run out and get some privileged access management real quick during this procurement cycle? Like, you can just go do that in this next 3 months. Like, it doesn't take 3 years to do or something, right? So that's been the hot one. We'll talk about that some more in a minute. But if you know for sure, like, hey, I don't have the basics. I have no MFA, I have no email gateway, I have no, like, if you don't have the basics, there's no point in jumping through the rest of these hoops. Do these things first. Unless, and the exception to this would be, for whatever reason, you can't get budget buy-in and you need the insurer telling you you have to do this as the reason to get someone to give you money to do these things. If that's you, come back to my talk at 10 and I will tell you how to make that not be you, and I'll teach you how to get real money instead of having to get like fear money. But if that's the case for you and you need fear money, then jump through the hoops and get your fear money or whatever. But for the most part, do these things first. If you don't have these things, don't keep going. It's a waste of your time, it's a waste of your money, it's a hassle. Like, you know you're gonna have to do this. And what's gonna end up happening is once you get through the application process, they're going to want you to do it in a hurry to get you underwriting, and a lot of these things take a long time, right? And you're going to want a longer runway, and then you're going to have to negotiate POAMs and stuff, and it's a whole thing. So as you're figuring this out, you want to not just do the external stuff. You don't want to just look at your controls. You actually want to look at your risk and start to try and understand what your actual risk is. And this is a thing that used to be really hard. So when I talk to folks about, hey, we should be doing risk quantification, a lot of the time people go, oh my God, risk quantification is hard. We tried that. I read the Doug Hubbard How to Measure Everything book, and I don't have a PhD in statistics. Or we tried FAIR, and oh my God, like, I don't have a guy who can break down all the stats, right? It doesn't have to be like that anymore. Like, folks have productized this. There are companies, Cover with K, 2 V's and 2 R's, X Analytics. There are several companies who have productized risk quantification, and it's simple and cheap and easy now, and I can actually tie dollar amounts to my risk, and all I have to do is basically like a critical 18 or an ISCSF, and if you're already doing that, you can tie dollars to it very, very simply. So it's not like the old days where you had to go jump through a bunch of FAIR hoops to pull off quantification. So we need to do some quantification, figure out what our money is, so we can figure out what our exposure is, so we can figure out how much coverage we want. This part, you're going to work with your CFO, you're going to work with your broker, and they're going to help you figure this out, because you're going to have other policies. You're going to have other types of coverage. You're going to have other ways that you can spend your money, right? Your CFO is going to have other goals. Potentially, we talked about the JP Morgan Chase model, where like you can set aside capital and do capital withholding. You can do self-insurance. You can insure through bonds. You can set up a captive where you insure yourself and set up a company that insures you that you pay into. You can do any number of things. Also, nowadays, like, let's say you need to get to, I don't know, $50 million worth of coverage. No one provider is going to give you $50 million worth of coverage. You're going to need 3 or 4 policies. They're going to have to build you a tower. I've yet to see anybody get to $1 billion. The biggest one I've seen so far is $600 million, but that's an enormous tower. It takes a ton of providers. It's a whole thing. You're going to need your broker to kind of hold your hand through this. However, I keep seeing people fall into the trap that is thinking your insurance provider and your broker are your friend, and your insurance provider and your broker are not your friend. Broker is in the business of earning commissions, and the insurance company is the same insurance company they are when it's your car insurance, your house insurance, or anything else, and we'll talk about that more later, right? Like, they're an insurance company. Their job is not to pay you or be your homeboy. Their job is to collect your premium and not pay you out, because that's how they make money, right? Because it's an insurance company. So we do need to work with our brokers. We do need to have them help us figure out this tower. We do need to be talking to our CFOs to figure this out. But we also have to remember that broker is not necessarily always your best friend in this scenario. So there are pretty much only a handful of companies that are the main companies that are the actual providers. So there are a ton of brokers and a ton of subs and people who kind of rewrite and reinsure and all this kind of stuff. But for the most part, the players have been the same for a while. Chubb was the #1 for a long, long time, but they've actually fallen down and they're no longer the #1. Hiscox has taken on a lot of kind of SMB, and so they moved into the #1 spot, mostly I think through quantity. AXAXL is really great for like if you are a tech company who has heavy tech, they like really understand the like hard to understand tech stuff. CNA seems to be really well balanced. Beasley's been a big player for a long time. There's nothing wrong with any of these folks, but those are kind of the big names, right? Consequently, they're each kind of have their own application situation, and we'll talk about applications a little bit more here in a minute. Oh, this minute, evidently. So when you start to figure out like, hey, it's time for me to apply, you're gonna reach out to your broker's gonna send you the application. The application's gonna depend on the provider, right? The provider's gonna send you back an application. It used to be, they were like 4 or 5 questions. Now they're like 4 or 5 pages of questions. The questions have a tendency to be very specific and detailed. Oftentimes, I get folks come to me and say, we don't even know how to interpret these questions, and there's nothing wrong with engaging a third party to help you with the interpretation of these questions. You will be tempted to go back to your broker and ask your broker to help you interpret. They're not qualified to help you interpret because they don't understand the security jargon any better than you do. Your insurance provider has no motivation really to help you figure out these questions, and so they don't do a very good job of it. So really you want to be reaching out to like whoever is the same folks that help you with your cybersecurity program, right? Your Presidios, Optives, WWTs, CDWs, et cetera, right? To help you try and figure this out. And you should have gotten the answers in phase 1, and we should just be applying them here in phase 2. If we didn't have the answers in phase 1, and you get here and you realize I don't know the answers, then you failed and you need to go back to phase 1 and figure out, should I even be filling out this app? So the other thing is they're gonna send it to you in a form that seems very yes and no. Like they're gonna send it to you in a form that like there's a space, they'll ask you some question like, do you have MFA all of the places? And there'll be spot for like a yes or a no. Well, if you say yes, you're lying because you don't have it all of the places and all of the use cases. Nobody does, that's impossible. And if you say no, then they're gonna dock you and not want to give you underwriting, right? So the answer is some gray area in between that you have to notate. So there is nothing wrong with not playing by those rules. Cut and paste their questionnaire out of their form and put it into a Word document and write the whole story. All of the details, all of the granularity, everything you would want to tell them, put it in there. Because what they want to understand is your risk. And the better you can articulate it, the happier they're gonna be. So back in that first phase where I said, if you can understand your risk and you can quantify your own risk and you can say, I understand my risk to, I don't know, data exfiltration through crimeware is $34 million and I have X controls that buy that down and I intend to buy down the risk of that through insurance by $7 million or whatever, like they love that story. They eat that story up because that's what they're trying to figure out and that's what they're trying to figure out from you. They don't know how to ask that story. They only know how to ask like, do you have PAM? Do you have a firewall? And so they're kind of asking the wrong questions because they don't know how to ask the right questions and you don't know how to answer the right question for the most part. But if you can tell that story, you can kind of shortcut the whole problem, right? So take their form, put it in your own Word document, answer it the way you want to answer it. Make sure you're telling the truth. The other thing that happens here is when you don't tell the 100% truth, you're giving them a reason to deny your claim when the bad thing happens, and this has been happening more and more and more. I saw recently a statistic, and I couldn't find it again. It was somewhere in the neighborhood of like almost 1 in 4 claims in the last year were denied based on your answers didn't jive with your application. I tried to find it again because I saw it and then I didn't capture it and I couldn't find it, and I've been trying to find exactly where that source came from, but that number is shocking to me, and if that's anywhere near true. So we need to make sure that we are telling the truth so we're not giving them a reason to deny us, because what's going to happen is the bad thing's going to happen. You're going to do a forensic investigation. The forensic investigator is going to say, here's how the bad guy got in. Here's what happened. Here was the kill chain. Here was the chain of events. And they're going to go back and they're going to look at your app and say, well, how did that happen? You said you have XYZ controls. That shouldn't have happened. And now you're left holding the bag and they don't want to pay you. After you do the application thing, they're going to come back at you and there's going to be a negotiation that happens here. A lot of the time, this is when people pick up the phone and call me and say, hey, the insurer called me and told me I have to have XYZ to get underwriting. Now, the idea that they have mandated to you that you have to have XYZ already is not entirely correct. they have requested as part of a contract negotiation that you do these things to execute this contract. You have options here, right? Like, you have several options here. The first one being, do the ROI math to make sure that this even still makes sense. Because just because the math made sense initially that I was going to pay X amount of premium to buy down my risk by X amount of dollars, and that made sense, as soon as I throw in, like, well, they came back at me and told me I needed to install privileged access management, and now I go do the math and I have to install CyberArk, and CyberArk's going to be $1 million, and then $1 million to install and $1 million to run for the next 3 years. Well, does that extra $3 million change the calculus? Well, hell yeah, it changes the calculus. Does this still make sense at all? Well, maybe not, right? So what happens a lot of the time is we feel pot committed. We already got this far into the process. They're telling us we have to do it, so now we have to go do it. Well, not necessarily. The first thing we have to do is figure out, does this still make sense? We can tell them to kick rocks. The second thing we can do is not necessarily decide yes, no right away. We can tell them, okay, hey, what you've asked for is privileged access management. That's a lot. That's like a 3-year project. We need underwriting in the next 90 days. Here's our plan. Here's who we're working with. Here's how we're executing this. Here's our POAM for how we're going to get from point A to point B. And a lot of times that will get you where you need to go. And maybe even a negotiation where it's like, okay, well then in year 1, we'll do such and such. And when you can prove in year 2 that you've hit X milestone, we'll reduce your premium or whatever, right? Will happen sometimes. So when they come to you and say, hey, they've told me I have to do all these things, what they've really told you is, hey, we have a negotiation to be had about understanding your risk and your risk posture and fixing your risk posture in advance of giving you underwriting. So part of the question also then is, how good of a job did you do when you were filling out your application, telling your risk story, and do we need to retell your risk story better to paint the picture that is $3 million worth of PAM really gonna fix my risk posture any? And that's another story you can go back to them too. Like, hey, if you really understand and you've done the risk quantification and you own a thing like X Analytics, it's very easy to model and go back and be like, look, you're asking me to put in a $3 million control that's gonna buy down this risk to this particular problem you're worried about by this amount. This control would buy it down by this amount. Wouldn't we rather do that? And they'll be like, heck yeah, thank you for understanding that. And they'll get on board, right? Phase 3. So what happens next is they're going to send you a policy. You're going to get this quote, you're going to get this policy, and it's a big legal contract full of crazy legal terms. And you got to read through it, and you got to parse it, and it's kind of a nightmare. So there's a bunch of stuff in here. What we're going to find is a list of all the coverages, the kinds of coverages, the harms that are covered, what things are covered, what things aren't, what things are covered at what level, what are the terms, so when are things covered and when are things not covered, what are the exclusions, and then what is the process if I want to fill out a claim, and then sometimes there's some extras and stuff we'll talk about. So the first thing is, what are the harms? What stuff is covered? And we talked kind of at the beginning, I said I think we've hit the kind of high watermark of what things will and won't be covered. In the early days, cyber insurance was like breach insurance. Well, now it's all kinds of stuff. There's all kinds of harms that can be covered in here. Outages are covered, outages for malicious reasons, but also for just accidental reasons, your outages, your provider's outages. You'll find fraud stuff in here. Somebody tricked your CFO into cutting a PO to somebody. You'll find all that kind of stuff in here too. You'll find social engineering things in here, fines for PCI, all kinds of stuff you'll find in here. And what things are covered depends on your policy. Also, you will find that sometimes they have different, what are known as sublimits, which we'll talk about in a minute. So like, just because all these things are covered doesn't necessarily mean they're all covered to the same amount. So you got first-party coverages and you got third-party coverages. So first-party coverages are the things that cover your direct costs. If the bad thing happens to you and you have to pay the direct cost of it. Third-party coverages cover like things associated with like damages, legal claims, stuff that you would pay to other people if you got like sued behind it. Then you're going to find next to all of your coverages all these other things. So the first thing is sublimit. So let's say you have a $3 million policy. Not all of your stuff is necessarily covered to $3 million. You might have some stuff that's only covered to $250,000. So you got a $3 million policy, but maybe fraud is only covered to $250,000. Or maybe some other thing has some other reduced sublimit, and you have to look and see, hey, what things are covered to what. So in this particular one, PCI costs are capped at 50 grand. There's not a lot of other. Retention is the same thing as deductible, and this happens in a couple different ways. Sometimes these deductibles are one deductible per claim. Sometimes they're one per harm, right? So like in this scenario, that could be potentially a big difference, because if you look at this and say like, hey, we had a ransomware event, and it was a breach with extortion that created data loss and business interruption, right? Do I pay a $10,000 deductible, or do I pay a $10,000 deductible 5 times? That's a big difference, right? So we got to figure that out too. The other thing that you'll find in here is for outages, there's this thing called waiting period. And waiting period is how long do you have to be out before they will pay you. So if you are down, if the ransomware people knocked your network out, or you accidentally knocked your network out, 8-hour waiting period means you have to be down 8 hours before you can even start filing a claim. So a work day, sometimes this is 12 hours, sometimes this is 24 hours. So what are most of your outages? For most people, most of your outages are less than 8, 12, 24 hours for sure, right? So most of your outages probably aren't even covered. You have to be out for 2 days or whatever before you can even start filing a claim. So as you're trying to figure out like, hey, does this policy fit my needs? Well, is this one of the things you're worried about, and what is the BIA of you being down, and how long can you be down before this is a problem, and what do you really need for coverage, is a conversation that you need to have, right? Also, all in these terms are like, when does your coverage kick in and not? So there's this idea like, hey, it takes a long time to find a breach. So the breach that you found today maybe happened a year ago, 2 years ago, 3 years ago. Did you have this policy a year ago, 2 years ago, 3 years ago? Did you have some other policy? So the idea that there's a retroactive date or full prior acts is the stuff that happened before, is it covered? If it's covered, is it covered back to what date? So full prior acts would be everything that happened before we're covering it. Then on the other end of that, there is, once you stop paying this policy, what happens if you find stuff that happened during this policy? There's an extension period. Usually you can pay them some multiple of your premium to get it extended in case the next policy doesn't have full prior acts coverage or whatever. Also, you'll find in here, duty to defend. Do they have to defend you in court, or do they have to reimburse you for defense in court? We'll talk about that more here in exclusions when we talk about making sure that your coverage, so that you don't get Joe Sullivan from Uber. Also, M&A coverage. What happens if you buy another company, or another company buys you, you go out and buy another company, does your coverage carry over, right? The exclusions. There's a bunch of stuff to know in exclusions here. So terrorism's not such a big deal one. Every policy has a terrorism exclusion. For the most part, we know that's going to happen, and terrorists are not a big threat actor. We don't have to worry about Al-Qaeda hacking us, really. We have to worry about the big, like, North Korea, Iran, Russia, China, right? Which will fall more under acts of war. So also we have TIRA, which is the Terrorism Risk Insurance Act or something, that says basically we will back, if like a terrorist act happens, you're backed, right? Even if your insurance isn't going to cover it, you would be backed. However, the government's never really come out and explicitly said, like, what would that look like, and what would be considered a terrorist act, and how much would they cover you, because they don't want to. So at the same time, it leaves the insurers being like, hey, it kind of leaves us in a position where we don't know what's going to happen. But for the most part, if some terrible terrorist thing happened, you'd probably be covered, even though it's excluded from your insurance. On the flip side, though, acts of war is a huge problem right now, and I'm going to tell you about a terrible problem that I don't have any solution for, and I'm just going to tell you it's terrible and scare you and then not give you any solution. Sorry. So back in 2017, we talked about the whole NotPetya. Russia attacked Ukraine. They attacked their accounting software with this thing that looked like ransomware, but it wasn't ransomware, and it got out, and it got all these places, and it hurt all these businesses, right? So they tried to file claims against their insurers for these damages to the tune of billions of dollars. The insurers were like, whoa, 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 no, no, no. This was Russia attacked the Ukraine, that's obviously an active war, we have active war exclusions, we're not paying you for that. So then it ended up in court. Court's like, well, there's a few things here. Is that an active war? There was no like war declared at the time. Like, is it not? Does cyber count as active war? Who knows? They kind of got around having to answer that question because of the way that they filed against the policies, and there was no cyber inside of the property policy that they ended up filing against, so they ended up kind of winning a settlement based on that. But if that were to happen again today, all that's fixed. All the language is fixed. They would not win today, and all that stuff is still going on today. Russia, Ukraine, happening again today. War is actually declared. There's actually kinetic war happening today. All the same stuff. They are using like wipers that appear to not be wipers. They are using wipers that are wormable, so that there, but by the grace of God go we, that some wipeable wiper worm has not escaped and done the same thing, at which point it really would be an active war because war has been declared. You really wouldn't be covered because everybody's got it baked into their policy now behind the Mondelez cases, so you would really be left holding the bag, and there's no tier of backstop for that. So like, we could all be in a real world of crap if that happened, which could happen tomorrow. So that's me telling you, I don't know what's happening. Like, all of insurance could go terrible. All of corporate America could really take a terrible, terrible hit. Who freaking knows? This is kind of sort of addressed in the national strategy, but not really. So who knows what they're going to do about that? Other things to note in here in exclusions, breach of contract. So frequently you'll find an exclusion that says like, we're not going to cover your costs for breach of contract, but a lot of the time you will have written into your contracts that it would be a material breach for you to disclose their data or whatever. If you have that in your contracts, that can be a real problem. You got to make sure that whatever you have written in your contracts about like data disclosures jives with whatever you put in your policy. That is a very easy thing to fix if you knew to look for it in advance. It's also a very big problem if you forgot to look for it in advance. Physical destruction is usually also not covered in cyber. It's usually covered under property. However, with like ransomware attacks, OT and stuff now, there's a discussion you need to have with your broker and with your CFO and stuff about like, hey, do we want this stuff covered under property? Do we want it covered under cyber? Like, especially if you're like a manufacturer or a healthcare or somebody who has like massive OT infrastructure, especially if I was a healthcare where like the Ponemon Institute just this year for the first time officially said out loud ransomware is actually killing human beings, and nobody had ever said that out loud before. So like, I would be real worried about that kind of thing and be like, okay, where does that fall? Like, it seems very callous for me to say like, where does the death of human beings from ransomware fall in an insurance point of view, but like, as a CISO, you gotta worry about those kind of things. And the last one is officer liability. So to avoid being Joe Sullivan, you need to be on the policy. And this has been a real kind of deal breaker for folks. Officer exclusions are very common. D&O usually is a separate policy that you need to be on. You need to be named, both named and positionally. So positionally says like you are covered as the CISO, but named says you are covered by name, Walt Powell, even after you leave, and that was what Joe Sullivan did not have. So they had no duty to defend. He had nothing. Now, he also had criminal. That wouldn't have helped him at all for the criminal side. But at least for the civil side, had he had been named, they'd had a duty to defend. He'd had like lawyers from the insurance company, and he probably fared a whole lot better. So you got to make sure, like, if you're going to sit.
So in the same way, like, for example, our CEO, we have to physically name him then?
Yeah, and probably in your D&O policy. And it's a conversation you for sure need to be having at least. Hey, are we covered? Where are we covered? How are we covered? Especially like SEC rules are coming out. And so far, Caremark challenges, and I'm not going to get, I'll get into that a little more in the next talk if you want to get real wonky on like law and junk. But like Caremark challenges have been a thing you haven't really been able to get across the finish line. That's that I have a duty to shareholders, and that duty extends to cyber. But like, partly because it's not against the law. Like once this SEC thing gets across the finish line, like that's going to change the playing field a little bit. And the way that they keep like the new McDonald's lawsuit that now says like officers have the same responsibilities as board members as far as like duty of care and stuff, like if I was still sitting in a C-named seat, I would be real anxious about all those things, and I would want to make sure that my name was on the DNO. we got to know how they want us to file a claim. So this is going to be, as we're figuring out the contract, it's going to have a bunch of information about like how do we want to file the claim, and this falls into two buckets. Sometimes people want this, and sometimes people need to think through it. So when I talk to people and they say, hey, part of the reason I'm buying cyber insurance is because I want them to lead the charge for me if the bad thing happens. I want them to be my incident response. I want to be able to call their hotline and have them give me a forensic firm and give me a lawyer and give me a breach coach and lead the charge, right? That's part of what I'm paying for. That's the value I'm getting from it. Sometimes not. I tend to be in the camp of not. So imagine, heaven forbid, that your house burned down. Would you call the insurance company and say, hey, insurance company, would you please call the fire marshal and then go get me like an architect and a builder and come to the table with us and help me pick out all my finishes and stuff? Like, no, you would never do that. You would go do all that stuff by yourself, and then you would be like, hey, insurer, give me money. But when it comes to cyber, for some reason, we think they're our friend and we want them to be part of our team. And I get it. If that's part of what you think the value is, great, make sure that's what you're getting and you understand like how you call their hotline and who's on their panel and stuff. We'll talk in the next phase about like what you might do instead.
On the previous slide,
Yeah.
Is criminal organizations excluded the same way terrorism?
No. So actually, very much not, because our ransomware is the biggest thing they're covering right now. So yeah, criminal organizations are definitely not excluded the way that state-sponsored and terrorist is. Now,
You have to respond to the terrorist group if they fall into the criminal.
currently not. Currently you have to be on the actual terrorism list from the United States, and that could get real interesting because as you think about these organized crime groups, sometimes they end up on the sanction list, which isn't the same as the terrorism list. And so far that's not been an issue, but as we talk about like how are they going to deal with ransomware from a national strategy point of view, like potentially that could become a problem. And then as you get to the end of figuring out your policy, just remember everything is negotiable. All of the stuff that we talked about, this is a contract, every part of a contract is redlineable. You can redline all of these things. That doesn't mean they're going to accept all your red lines. Work with your broker will help you figure out what things they will probably be amenable to and what things they won't. But for the most part, a lot of this stuff is real easy to redline. Like, hey, if the sublimits don't meet where you're aimed at, if you need prior acts. We didn't talk about subrogation. Subrogation is the idea that, like, if you have a problem, like your provider fails and your insurer has to pay you and they have to go sue your provider, they're going to go sue your provider for that outage or whatever. Well, you might have stuff in your contract that says you can't sue them. Well, that would put you in a problem, and so you got to get a waiver of subrogation, blah, blah, blah. You just have to know that stuff in advance. It's not that big of a deal. They will help you work through it. But this exclusion stuff, getting your officers on D&O, if you need longer waiting periods, whatever it is, all that stuff is usually pretty easily negotiable if you knew to negotiate it for it, but you have to do it before you sign on the dotted line. What ends up happening so often is I talk to folks who don't figure this stuff out until after they've signed on the dotted line and they're trying to put together their plan, or they've had the bad thing happen and they're like, oh, we thought we bought X and we got something else. Like, this doesn't cover the stuff we thought it covered because we didn't read it, right? So make sure you read it, make sure you understand it, make sure that the policy's doing the things you think it's doing. Then this one is going to be unpopular because everybody groans when I say it and it sucks, but it is what it is. So one of the best ways that you can kind of put some leverage on these insurers, because a lot of the times people say to me like, hey, well, this is hard because the insurance companies have all the power, right? Like I go to them and they send me the application and they send me the thing they want me to do, and like the ball's in their court, they just tell me what to do, and if I want insured, I have to do this. Well, one of the ways that you can kind of shift some of the power is by creating competition, and I've seen a lot of folks move toward like turning procurement of insurance into like an RFP process, basically, where you're baking folks off against each other. RFP sucks, doing RFP sucks, nobody wants to do an RFP, but anything you can do to shift the balance of power a little bit and make them compete against each other and kind of take some of that like one-way back and forth out is going to help you do away with some of that like we're trying to impose our will on you. So the last part is once you've signed on the dotted line, you've got your policy, you've agreed to it, you're happy with it, blah, 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 blah. Now you gotta make sure that you're claim ready. If the bad thing happens, are we doing the stuff that the claim wants us to do, or that the policy wants us to do so that we can file a claim. And the way that you do that is by making sure that your formal incident response plan is lined up to your policy, and that whatever the things that your policy tells you to do are written in your formal incident response plan. So the first thing you're going to find in your plan, or in your policy, is a set of things known as the panel. And the panel sometimes is written right in your policy. Sometimes you got to go out to the provider's website to find it. But the panel is a group of providers that are pre-contracted with the provider. There's going to be lawyers and forensic firms and breach coaches and sometimes communication firms and any number of other services that have pre-contracted rates and are already buddied up basically with the provider that they can give you as a partner to help you through problems or whatever. When you call the hotline, for instance, and say, hey, we had the bad thing happen, they're going to assign you somebody off of the panel, or they're going to point you to the panel and say, pick somebody off of the panel, which would be fine, except oftentimes you don't have any relationships with any of these panel people. You've never dealt with them before. You don't have any paperwork in place. You haven't done NDAs. You haven't done contracts. You haven't done any of that. So you're going to now have to do all that stuff while your hair is on fire and the bad things happened. Wouldn't it have been better to get all that stuff out of the way in advance? Also, you probably have partnerships with some folks. You probably already have a third-party legal. You probably already have some forensic firm or some firm that does your cyber insurance who understands you, maybe an MSP who's already in your SOC or whatever, who would be better suited to do your forensic investigation. Also, maybe you have, I don't know, carbon black agents everywhere, and their panel partner is Mandiant. And Mandiant's going to want to come in and put the Mandiant agent everywhere. You don't have the Mandiant agent. Now you have to pay for the Mandiant agent. You have to wait for them to roll out the Mandiant agent to all of your millions of endpoints or whatever, when you already had a perfectly good carbon black that they can't use because Mandiant can't use carbon black, but Joe Schmoes, whoever else forensic firm could have used it, right? But they're not on panel. So it makes a lot of sense to try and figure those types of things out in advance. So I oftentimes suggest, instead of waiting until your hair's on fire to just take whoever it is off a panel, is to figure out who your team ought to be in advance, right? Because when you're trying to do an incident response, you don't want to, it's like, imagine trying to go play a baseball game with a team of folks who had never met each other before, and you're going to go try and win a game just like, we have no plan and we've never met, let's go win, right? So you got to have an incident response plan. You have to have practiced that with tabletops, and you should be bringing these partners into that. These partners should be helping you build those plans. They should be helping you build those run books. They should be helping you practice those run books. So whoever is your forensics partner should probably be on retainer. Those retainers should probably include, we'll talk about that in a minute, proactive stuff. You don't have to have all of the things on retainer, right? Like, so you don't need to have your own breach coach and your own PR and comms and whatever, but you probably should have whoever is your incident responder and whoever is your third-party legal kind of planned out in advance so you know who they are. Now, we talked about, like, are you trying to do this because you think the value of insurance is having them marshal this for you, or do you want to build these plans yourself? I tend to think building these plans yourself is better. If you're going to do that, you should put these folks on retainer. Your retainer should have a couple of parts. It should be a block of hours, like some hours to use retroactively. Those hours should be repurposable to proactive stuff, so they can come in and build your plan, they can come in and build your run books, they can come in and do your incident response tabletops or whatever it is. It should also have an SLA. Here's how quick we're going to show up. All the information about here's how to contact them in case of emergency and when to contact them, so that when your hair's on fire, you're not reaching out to the insurer trying to figure out, like, who should we talk to and how do we contract with them and how do we get our NDAs in place. Like, all that stuff should be done, and it should all be written in your playbooks, and you should know exactly who to call when and how that aligns to what your expectation is for not just recovery time, but for claim readiness and whatnot. You need to coordinate all that with your internal legal, but especially third-party legal. There is a benefit of attorney-client privilege that comes from leveraging your third-party legal. So if you can do what's known as a tri-party agreement, where your third-party legal actually contracts with the forensic firm, and the forensic firm is actually contracted to your legal, who's then contracted back to you on your behalf, right? So then all the communications to them are protected through attorney-client privilege. Now, that's only kind of sort of true because the Capital One case now dictates what things are and aren't attorney-client privilege, and they've decided that, like, cyber facts are not necessarily privileged, but the actual, like, facts aren't. But the all the advice is. So however you would interpret those facts is all covered. So making sure that you're doing tri-party agreements and using attorney-client privilege to execute any time that you're involving forensic type folks. Also, you'll find in these policies a lot of the time extras like freebies, just value add content that people aren't taking advantage of. I have seen almost every policy comes with at least some kind of portal access that's full of like tools for building incident response plans and all risk exercises and all kinds of just freebie tools you can go get. But I've even seen them, and this one's the example, where they will actually give you a kickback to make improvements to your posture. This one says we'll give you back 10% of your premium every year to make improvements to your posture that you can use toward new controls and junk. And when I found this in this particular company's policy, they'd had this policy for 5 years, and they had left 5 years of 10% on the table before we found it because nobody bothered to read it and catch it. I'm like, this is in there. You could have been using it this whole time. So make sure that you're finding all the value add stuff. As you're writing down your plans, though, one of the reasons that you might be taking on insurance is for ransomware purposes and extortion stuff. You have to be careful about what you write in your plans. Do not write in your plans that your intention is to pay ransoms. Do not write in your plan that your intention is to leverage a ransomware broker or anything like that. Do not keep crypto wallets. Do not write crypto wallet stuff in your incident response plan because all this stuff is discoverable. And what you don't want to do is go to court and explain in court why your plan to protect your clients, your customers' data was to pay the ransom, and here was your ransom plan. Like, that's going to look real bad, right? So do not write that stuff down, even if that is your plan. Don't write it down. So as you're writing this stuff down, it is important to write stuff down, but don't write it down. My official guidance is don't make ransom payments. And unofficial guidance is that's a case-by-case basis. You, your insurer, your forensic firm, your broker, your ransomware broker who's going to understand the attacker is going to be able to help walk you through that. Sometimes it makes sense to pay them, but it never makes sense to write it down. Then the last thing is your policy and your plan are huge targets. Make sure that you hide them. So put them not just in whatever is your backup, indelible backup, but they need to be encrypted because if they go into your Veeam, rubric, whatever, where they're indelible, that's great, but the bad guys are in for a long time. They're in for months. And when they own your Active Directory, they own the keys to everything. That means they own your Veeam. And just because they can't go in and erase your backups doesn't mean they can't read them. And they love to go into your rubric and read all your backups. They will read your policy and they will read your plan and find out exactly how much money to ask for and exactly what you were going to do in response because you wrote it all down. So make sure that you hide it and don't tell the bad guys what you're going to do. So right to the wire. Questions, thoughts, concerns? Are you bored to tears about cyber insurance? You have a look on your face like you really want to ask a question. There, that's where you start. So that's your framework. When in doubt, call me, Walt Powell at cdw.com. We will walk you through the framework. I have a pre-made thing for pretty much all of these steps. So I have a doc where we can come in and do all your comparisons for you and compare your policies to each other. We can come in and do your risk assessment. We can figure out your scorecard score for free, basically. We can, you name it, we can help you along the path. So like where do you start? That's the easy part. The answers are the hard part.
How much of the claim typically gets stuck or gets lost by legal fees?
Say that one more time.
How much of the claim gets usually stuck or lost by legal fees?
Oh.
Depending on which yourself to get like what you know.
So the legal fees are actually usually part of the coverage, and when we talked about the harms, like you can claim them separately. So honestly, it's up to your cap. So generally, your thought is a good thought that like, hey, we're probably losing a good chunk of what we're getting back in legal costs. Yes, legal costs are one of the biggest parts of what we're paying out, but basically, it's covered as part of your policy up to your cap. I do, yes. I am a big believer in that. Now, you have to ask yourself, like, are you getting into cyber insurance because of the value add of having them be that champion for you? But if you are there things that you could do even for their, like, can you pick off their panel in advance? Can you get that contracting done in advance? Can you do any of this stuff in advance so that you're not playing the baseball game with strangers, right?
Have you seen firms amicable towards doing that in advance without paying for hot dollars as the original retainer, like the insurance company is kind of the one putting them on retainers, so they're willing to work with you to do all that?
So there's a thing that's real popular in the industry right now called a $0 retainer. They're usually garbage and they're usually not worth the paper they're written on. But if you pay good attention, it can be worth doing. So generally, the only purpose of the $0 retainer is to have the paperwork done in advance. So if you understand that you're doing it with someone who's on panel who is pre-approved and whatnot, then it can make sense. But what happens a lot of the time is whoever is your cyber insurance folks will come in and say, hey, let's sign a $0 retainer. And you're like, $0? Why not? Well, then when the bad thing happens, they're not on panel, they haven't pre-negotiated with your provider, their rates aren't aligned, blah, 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 blah. And now you can't use this thing and you end up using somebody else and then they look stupid and you still have to go do the other thing. It's usually really easy to get whoever you want on panel as long as you do it before you sign on the dotted line. So on almost every policy, there is going to be a line that says, whoever you want as your provider, as long as they agree to our terms and you provide X written notice to X address or whatever, then we'll put them on panel. And it's usually not a big deal at all as long as you do it before you sign on the dotted line. After you sign on the dotted line, usually they're not as amiable to those kind of changes. But so I'm not sure I understand the question. You want to add entities or?
Yeah, we're running into more and more customers out there who are saying, we want to be added not only to your CGL policy and development policy.
Oh, your customer wants to be named on your policy.
And I know from past dealings, our insurance carrier has basically said, go policy, and it's never going to happen. And when we put out the RFP previously, obviously that's what we got in full. But we're seeing even more and more of that. I mean, just in the last 2 months alone, I can rattle at least 10 times. We've been asked for, we want it and demand be put on your policy. And we're like,
Yeah,
we will not do it.
it's generally a non-starter, and I generally tell people who are having clients or customers come back and ask them, give them specific cyber insurance requirements to push back super hard and tell them to kick rocks. Because even though things have looked up, the whole industry is still real shaky, and that idea that, like, will this even still continue to be an option? Will you be able to get insurance in your size for the harms that you're talking about, for the levels that you're talking about? It's still up in the air, right? Like, there are lots of bad things that can happen to you in life that you can't buy insurance for, and there are going to be portions of the cyber landscape that is true for, and we don't know what they are yet. And so we're painting ourselves into this corner where I started off saying, people ask me all the time, hey, Walt, do I even still have cyber insurance in 2023? Should I drop it? Well, a lot of people can't drop it because they have regulatory or contract obligations that tell them they have to have it. Well, what's going to end up happening is you're going to end up in a situation where you can't get it or it doesn't make financial sense to get it, and now you've painted yourself into this corner because you're going to be in violation of some customer contract that was a BS contract in the first place. So I would push back on all of that because there's a good chance that you're going to find yourself in 2 or 3 years in a scenario where you're not going to be able to support that contract clause that you could support today. I would push back super hard, even if the insurance company wasn't pushing back super hard.
Guys, we've got to wrap up so I can give the.
Yeah, we're over. We're over. Thanks.